Every financial bubble starts with confidence and ends with circular logic. Right now, global markets are being propped up by a dangerous loop of circular financing, a self-feeding system where borrowed money props up valuations which are then used to borrow even more. It's the illusion of growth, created entirely by leverage. And like every illusion, it ends the moment confidence breaks. What is circular financing? Circular financing happens when money flows through the same system multiple times, creating the appearance of strength, even when no real wealth is being created. Here's how it works. Corporations issue debt to buy back their own stock. The rising share prices boost market value, allowing them to issue even more debt at lower rates. Investors, seeing momentum, pile in, often with borrowed funds of their own. Banks, flush with inflated collateral, lend more. Asset managers buy more bonds. Governments print more money to stabilize the markets, and the cycle repeats. It's a financial ecosystem that feeds itself until it can't. Why it's so dangerous? Circular financing creates a feedback loop of false confidence. Everyone feels richer because the numbers go up. But underneath it, there's no real productivity growth, just financial engineering. It's the same mechanism that fueled the housing bubble in 2008. Mortgages were packaged, repackaged, and leveraged again until the entire system was built on circular credit instead of actual income. When the loop broke, everything crashed at once. Today, the same dynamic exists, just on a bigger, more global scale. Corporations, hedge funds, and even governments are financing each other's debt. Money isn't flowing into innovation or production, it's circulating between balance sheets. That's not capitalism, that's cannibalism. The illusion of infinite liquidity. At the heart of this cycle lies one dangerous belief, that liquidity will never run out. Central banks have conditioned markets to expect easy money forever. Every time volatility spikes, the Fed, ECB, or BOJ steps in with a safety net. This has made investors reckless. Why worry about risk when you believe someone will always print more cash? But liquidity isn't infinite. Once rates rise, debt servicing costs explode. The same corporations that borrowed billions to inflate their stock prices now face shrinking profits and higher refinancing risks. When liquidity tightens, as it's doing right now, circular financing unwinds in reverse. Prices fall, collateral evaporates. Margin calls hit, the feedback loop turns vicious. Why? It's already unraveling. We're already seeing cracks. Credit spreads are widening, corporate defaults are rising. Banks are becoming cautious about lending. Even sovereign debt, once considered untouchable, is under strain. Governments are issuing new debt just to pay off old debt. That's not growth. That's survival. In essence, we've built an entire global economy that depends on rolling over yesterday's debt to pay for today's market stability. That's the definition of circular financing and the recipe for systemic collapse. The next crash won't start on Wall Street. It will start quietly, in corporate bonds, private credit markets, or shadow banking. Somewhere in that chain, one player will fail to refinance. The contagion will spread fast because everyone's exposure is interconnected. And once that loop breaks, no central bank will have enough tools to stop the chain reaction. The bottom line, the next crash won't be caused by greed or speculation alone. It will be triggered by circular dependence. A system that finances itself eventually destroys itself. The question isn't if the loop breaks, it's when. And when it does, the fall will be faster and deeper than 2008, because this time, the entire world is part of the same circle. If you found this analysis helpful, hit like, subscribe to Financial Vlog, and turn on notifications for no-fluff breakdowns of money, markets, and the coming economic storm.